Hi guys, Stanley here. I'm the co-founder of valueinvestasia.com, an investment portal where we give you investment news and in-depth analysis on listed company every single week. So if you're new to this channel, remember to hit that subscribe button so you'll not miss out on our future videos. One of the most satisfying aspects of an investor is seeing dividends flowing into your bank account. After all, this flow of passive income represents a real cash return on your investment instead of just paper gain. And fortunately, the Singapore market is a gold mine for finding dividend stocks. And the best dividend stocks will come from businesses with strong business moat and a healthy track record of profitability and free cash flow. So after looking through the Singapore market, here are 7 stocks that you might want to consider as your next dividend investment. Number 1, the Singapore Exchange Limited. Singapore Exchange Limited, or SGX, is Singapore's stocks exchange operator. The group operates a platform for buying and selling securities like equity, fixed income, currency, and even commodity here in Singapore. For the first half of this financial year, its revenue inched up about 0.2% year-on-year to 521 million. The company has some mixed results though. The higher trading volume in commodity and currency was offset by lower equity trading volume and a lower average clearing fee. Its operating profit declined about 4.8% year-on-year due to higher expenses. And its net profit fell even more at 8.8% to 218 million. Yet its interim quarterly dividend will remain at 8 cents per share. So its annualized dividend for the year 2022 will stood at around 32 cents per share, giving SGX a dividend yield of roughly 3.4%. So going forward, the group is working on several key areas to grow its business as well. This includes building up the exchange traded fund business, its special purpose acquisition company or SPAC, and the environmental, social and governance industry. Its CEO, Mr. Low, is determined to morph SGX into a successful multi-assets exchange, and has hinted that it will pursue opportunistic acquisition as well to boost this area of businesses. So SGX should still be able to maintain a stable dividend in the future. Number 2, UMS Holdings. After looking at large cap like SGX, we can now turn to a smaller but still impressive company, UMS Holdings. UMS produce equipment and also provide services to original equipment manufacturer or OEM of the semicon industry. And the group reported a stellar result last year. Its revenue surged about 65% year-on-year to 271 million, while its net profit increased about 46% year-on-year to $53 million. The strong performance was due to the increased demand in microchips and also the increase in capital expenditure for many semiconductors factories worldwide. In fact, the Semiconductor Equipment and Material International, or SEMI, has projected that equipment spending for the front-end facility could jump about 18% year-on-year to an all-time high of 107 billion this year. UMS operating cash flow also hit a record high of 66 million this year, and GMS declared a final dividend of 2 cents per share. So for the year 2022, a total of 5 cents of dividend has been declared, and that will give you a dividend yield of around 4%. So the prospect of UMS is still looking very bright. Next, Venture Corporation Limited. This is another company in the electronic space, Venture Corporation. Overall, the electronic sector was one of the few that have stayed strong during the pandemic. Some companies like Venture Corporation even managed to increase its dividend during this period. Venture Corp is a provider of technology products, services and solutions. Over the years, the group has really built up key know-hows and expertise in domains such as life sciences, genomics, consumer products, and even fintech, to name a few. Venture Corp capability are demonstrated by its portfolio of more than 5,000 products and solutions. The company last year has a revenue that rose 3.1% year-on-year to $3.1 billion. Meanwhile, its net profit increased by 5% year-on-year to 312 million. During the year, the group declared a dividend of 75 cents per share, giving investors a dividend yield of around 4.7%. And the company is already looking into the future, and with its long history of success, Venture Corp has a good chance of sustaining that dividend payment. Up next is quite a unique company, UMS Holdings. This company is a beneficiary of the increased demand in semiconductors during the past few years. The company designs, manufactures, and market high-precision tools and parts to be used in the manufacturing process for the semicon industry. And the group now has 5 production facilities located in Singapore, Malaysia, China, Philippines, and the US. Micromechanics has been growing in tandem with the demand for electronics. Last year, the group reported a record performance with revenue rising 14.8% year-on-year to 73 million. Similarly, its gross profit also increased about 16.6% year-on-year to 40 million, while its net profit climbed about 23% year-on-year to 18 million. And with great power comes great dividend. Consequently, Micromechanics has been generous in increasing its dividend, in line with the better results. So overall, its annual dividend has really more than doubled from 6 cents to 14 cents since 2016. The company has a trailing dividend yield of about 4.5%. As for its prospect, its CEO believes that the semicon industry is poised for a prolonged period of growth, as more microchips will become embedded in many more devices around us, aka the Internet of Things. On top of that, the boom in industries such as cloud computing, artificial intelligence, and self-driving cars will also require more chips, all benefiting Micromechanics business in the years ahead. So talking about long-term dividend stocks, this one is clearly one to watch as well. Now let's move back to some other larger caps. The next company is Singapore Technology Engineering, or STE. STE is a technology, engineering and defense group. The conglomerate serves a wide range of customers in the aerospace, smart city, defense system, and the marine segment as well. STE reported a good set of earnings last year, with revenue rising about 7.5% year-on-year to $7.7 billion. Meanwhile, its net profit rose about 9% year-on-year to 570 million. As for its dividend, they stood at around 15 cents per share. And with the current share price, that translates to a dividend yield of roughly 3.7%. And the next company is one with the most boring business you will come across. And when it comes to dividend, boring is good. Vicom is the provider of inspection and technical testing services. Last year, the group reported a 16.7% year-on-year rise in revenue to $100 million. And its operating profit edged up about 5.8% year-on-year to 31 million. Unfortunately, its net profit only inched up 1.2% year-on-year to 24.8 million. But what is most important to you is its dividend, which total about 8.3 cents per share for the year. And that would translate to a dividend yield of roughly 4.1%. So if you're looking for a stable, boring business, but yet growing, then this one is to watch. And finally, our last company is Raffles Medical Group. Raffles Medical is a healthcare service provider that operates in 14 cities across 5 countries in Asia. In Singapore, it is the most visible as the owner and operator of Raffles Hospital. Other than that, Raffles Medical also operates a network of clinics across Asia, providing services like health screening, medical services, and dental services. The group also opened 2 new hospitals in Chongqing and Shanghai in 2019 and 2021 respectively. During the pandemic, the company has really adjusted its business model by helping the government to do many PCR tests and also pre-departure swabbing for cruise passengers. The group has also partnered with the Civil Aviation Authority of Singapore to provide PCR tests for tourists or travelers. Although medical tourism has taken a hit and many overseas patients have since postponed their procedure, Raffles Medical still managed to report a 16% jump in revenue year-on-year. That said, its net profit last year fell about 7% to just 45 million for the year. Raffles Medical declared a final dividend of 2.8 cents per share, and that includes a 1 cent special dividend. All that translates to a dividend yield of roughly 2.5%. For its growth prospect, most of it is still betting on the growth of its China hospitals. But with border now opening in Singapore, the group should see better performance locally as well. So there you have it. That's my take on the 7 key dividend stocks that you might want to keep in mind. Which one is your favorite and why? Remember to share your thoughts with me. If you've gotten value from this video, I hope you give me a like and share it with a friend who you might think will benefit from it as well. And if you're ready to take the next step into investing, you can always check out our free investing course at valueinvestasia.com/free course. As always, my name is Stanley. Till we meet again, invest safely.